going on, everybody? This is Dylan, Carlos, Daryl. Welcome to Generation
Oosh.
So today we get to start off by going over some fun, exciting loans. Yes. What are y'all's favorite loans? This is what we get to talk about. What loan do you use for your refinances for your rental properties? Not personal properties. Personal properties, you're going to go to your personal mortgage broker. With a rental property, you can't just go to them. I mean, well, you can if you have W-2 income, but for us, we can't just go to them and get a loan.
So there's a specific type of loan that a lot of investors like to use, and it's probably been more recent, like in the last 2 years, that a lot of people have been using them. They don't require tax returns. They don't require W-2.
Yep.
The things they do require is to make sure there's a lease on the property and to make sure the lease covers a mortgage. These loans are called DSCR loans, and it stands for
Debt Service Coverage Ratio.
And what does it mean?
I was gonna say when I tell people that, they're like, their brain just shuts off, and they're like, "You just talk a foreign language?
Yeah.
Like, what is a debt service coverage ratio?"
So break down the definition.
Yes.
Debt service. So debt service is the debt that you have on the property, right? And the coverage of that debt based on the income that you have coming in from said property. So these DSCR originally came from commercial loans.
Mm-hmm.
Yes.
Boing, boing, boing.
I think your phone is too heavy, or
It's tripping the algorithm.
yeah. Good though.
All right.
But yeah, keep going.
All right. So debt service coverage loans originally started with, or at least that's where I see it. It's starting from is like commercial lending, right? Because that's how they calculate multifamily deals. That's how they calculated commercial loans back then. Right?
True.
Back in the day, look. So if you talk to anybody who's been investing in real estate for 10 or whatever years, they essentially use the same formula, but they underwent different kind of requirements. So they did have to have W-2s, or not W-2s, but like they did have to have tax returns.
Yes.
They did have to show
Right.
it. So it's different, but the formula is still the same.
Yeah.
Right? So what's the formula?
So I'll take it over. So the formula is so they look for a ratio. So a lot of banks, it's 1.2, 1.25. Some of them are 1.1. And what does that mean? So that means if the house is renting for $1,000, if the house is renting,
Make it easier. 1%. Just show them because 1% is the easiest. 1,500 to 150 is essentially a 1% debt service ratio. 1.2 is going to make your math hard.
No, but that's what they. What do you mean 1%? You mean
Just
one,
imagine
one
if it's
to one?
a 1. Yeah.
Okay,
percent
you
debt
go
service.
ahead. Take it over.
So like a 1% debt service coverage ratio, if it's a $150,000 loan, it needs to at least rent for $1,500 a month to cover 1% of the monthly debt service.
So I think they're looking at the mortgage.
Yeah, they're not looking at.
They're not looking at the
value.
They're not looking at the size of the loan. They're looking at
Okay, gotcha.
they're looking at the size of your mortgage payment.
Yes.
Right? So like if your mortgage payment, real simple, if your mortgage payment is $1,000
Yep.
and you're collecting $1,200 in rent, so if you throw up the formula up, it'll be $1,200 in net income.
Yep.
Right? Or in gross income, right? Up at the very top. And then your your expenses, your
Minus
mortgage
that 11.
is divided by 1,000 because
Yep.
that's what you have to pay. So if you do that math, you'll get a 1.2,
Yes.
right? So then now they'll see, okay, cool. You make 1.2, or you make 20% over what your expenses are for that property.
Right.
And depending on the bank that you use, because there's a lot of DSCR lenders out there.
Yes.
So depending on the bank that you use, they'll have different requirements. They'll have 1.15, so you have to make $1,150 over the 1,000 mortgage. Some have 1.2, 1.25, 1.4, and that's when you start to become more and more conservative because some people only borrow at like 1.5. So their mortgage their rent has to be $1,500, which is
Crazy.
and the mortgage has to be $1,000.
Yeah, so they'll take $1,500. That's what you're getting in rent. They'll times that by 70% because they'll assume 30% expenses, right?
Yep.
So that'll leave you with around $1,000. So that means, let's say $1,100. That'll leave you with $1,100. If the mortgage is $1,000, it meets the 1.1 ratio, basically.
Refresh.
you're netting 1,100. The bank's assuming you're netting 11. Mortgage is 1,000. You'll meet the 1.1 ratio.
Yep.
Meaning some banks might give you the loan on that.
Yeah, and now the more and more loans that you do like this, the more kind of create, depending on how good of a deal you got, the more the more you can push the limit on those kind of loans, right? Because if you if you bought a property and you're able to push rents, right? If you're able to push rent and you can get $1,700, right? And then you bought the property at like, I don't know, $95,000 and you put like $50,000 into it, but like there's still some room where you could still kind of push the loan up some to get close to what the requirement is of like 1.2 or 1.25, then you can get more. So this would be like the ideal burr of like, now I can push my loan up a little bit more, get all my money back, and get a little bit more. Like once I refi.
Yeah, because you're increasing you're pushing the rent.
Because of the rent. So so that's something that you can kind of control when you're trying to push those.
Right.
Now, some banks though will look at what you're getting for rent versus what market rent.
So mine have never used what you're getting for rent. Mine only uses what the market rent comes back on the appraisal, and that's it.
Oh yeah.
And that's what they dictated. Even if my rent is $1,800, the market rent is $1,600, they're using $1,600.
Yeah.
Yeah. I don't know about y'all's, but
I think mine usually use the lower of the two. So if the market rent comes back if the market rent comes back at $1,200 and it's renting for $13, they'll use 12. Another thing that with these though, if the interest rates are rising, it really does screw up your ability to pull out enough money.
Yeah.
Because now your mortgage is getting, instead of $600 at a 3% interest rate, it's now $1,000 at a 6% interest rate or 7% interest rate.
Yep.
You're not going to get approved for as much unless the rents are significantly above that. So in a rising interest rate environment, it's a lot tougher unless you're buying cheaper houses. But if the rates are low, you can buy more expensive houses and get all your cash, or a little more expensive houses and get all your cash out.
So could we oversimplify? Because I feel like we threw a lot of numbers.
Yeah.
And some people are going to get lost. Some people are going to get lost. All right. So let's run an example. I know we ran through one, but let's put some color to it, right? Like a house rents, like a real thing, right? Do you want to? Who wants to give an example of one?
So you have a house that you renovated, $220,000 is what your appraisal came in at. Okay. Your rent is $1,750 a month. Does it work with a 1.2%?
All right. You said 220 is what it appraised at.
Correct.
And you said what was the other number?
It rents for $1,750.
$1,750. And then what's the? You gave us
1.2 is what the bank is requiring.
Okay.
Which I would say typically.
Is this one of your deals, Daryl?
No, I just threw out random numbers. Yeah.
All right. Are they doing 70, 75%?
So let's assume 75%.
Yeah.
All right. So the max loan is 165.
Correct.
Okay.
So 165. Your rent is $1,750. All right. So let's figure out what the mortgage is going to be.
And what are the rates right now? 7.5%?
I would say, use somewhere around there. 7.5%.
7.5%. All right. So 165 is what it appraised at. You have to add back in closing costs and other. So let's call it 175, 170.
Are you tying in the closing costs to the loan?
See, usually, I don't know.
I don't have.
Do you not?
No. Allow me to do that.
All right. And then you said
I didn't know they allowed me to do that either.
6.5.
That would put it 7.5%, right?
7.5.
Yeah, you got to double click the circle button.
All right, at 7.5. At 7.5%, your mortgage payment is going to be
on the left and on. So it keeps on pushing it down. So
at 7.5, your mortgage payment is going to be about
$1,153.
Yeah. All right, so $1,150. What do you want to add for?
Well, the bank usually adds that
30,
back.
30. How much should I add?
30%. They usually times the rent times 0.7.
Yeah.
So your 1750 is now.
You said times 0.7.
Yeah.
Correct.
So they only take 70% of
They
that.
take
Now it's only
30%.
225.
They take 30% of the rent off
So it's
the gross rent.
1,225 is what they're going to tell me your rent is that you're collecting, right?
The net rent.
The net rent.
Yeah. Is that times
1.25.
0.7? Yeah.
Hold on. So
instead of you getting 1750,
1150 times 0.7, that's $850.
No, they're doing 1750.
1750 times 0.7.
times 0.7.
Oh, because they're subtracting it out of here. Okay.
Correct.
I was gonna add like taxes. I was gonna add escrow and all that.
Oh.
Yeah, I was gonna go up that way.
Yeah,
All right,
yours
so
is
yeah.
too heavy. And it's just pull it down.
So they're only gonna get you 122.
1225.
Yeah, no, that won't work.
It's not gonna work.
No.
Yeah.
So why is it not going to work?
Because they're only gonna recognize $1,225.
What's the mortgage?
Pre-escrow, it's $1,150.
So it meets like the 1%
Meets the
or the
1%.
one ratio.
Yeah, once you add
Well, it means like
once you add taxes and
1.05
insurance to it.
or so.
Once you add taxes and insurance to it, add another $200.
Yeah, that might work.
Nope.
Is this video gonna be a dud?
It might be.
It might be a dud.
Unless we just cut these out.
Yeah.
It might work now.
For like 2 minutes.
Yeah, and then it can
I
just fall
checked.
back down.
No.
Okay. So that one, so a house
That
appraised for
would not work.
220 that you want to
220.
get a refinance on at 75% LTV does not meet.
So that house will not work.
No.
FYI.
Now if you increase the rents to, let's say
1850.
it might work.
Then
The banks might do it.
close.
Yeah.
So
But that's if they recognize that's
If
not-
they recognize that your
The
rents are not
rents.
market rents.
oh yeah,
Yeah.
it's appraiser.
Yeah.
It comes back with the good rents. Yeah.
Because typically, if you're higher than what the market rent is, they're not going to use it
Yeah.
or qualify it as good data as rental income.
I mean, because the scary part for the bank is like,
What if the market goes down?
yeah,
And now
like
you
how much are you really
closer
cash
than the
flowing,
market cap.
right? Because like, sure, you're getting 1750, your mortgage is 1150 plus.
So now run that on the old rates, 5.5%. Would it have worked? Because then we can kind of prove that interest rates do fluctuate, whether the DSCR is going to work or not.
I bet it will work.
Because if you're
I think I got that exact loan, ARV of 220, 165.
if you're 5.5, it's $936.
Yeah, it's 936, so then it works.
So it does
at that
work.
point because it's $200
Yeah.
less.
Yeah,
So then you're really at 1150
correct.
with escrow, and yeah, so you're at 1 point.
So, in summary, though, you don't need credit. You do need credit checks for this, so they do
You
run
do.
your credit, but they do not collect your tax return. So
Job history, none of that stuff.
so it really helps out if you're self-employed or
Yeah.
you're just starting the business and you just quit your job and you need to refi.
Or you don't want to utilize your income and all that, because a lot of times
Yeah.
if you use your income, you can only buy 5 houses.
10,
You can,
right?
is it 10?
Fannie Freddie is 10.
Yeah, I think-
Oh, okay, gotcha. Yeah, so
But
10
like
properties.
that's what
but
I
that's
thought
if you
growing
qualify.
up. Like that was it. Yeah,
That's if you qualify. You
No,
better
they-
make a whole lot of money.
they do. I mean, it's a little lenient, right? Because like they'll take your full rent and they'll
Correct.
recognize it against that expense against that house.
Yeah.
But like that growing up, that's what I thought it was the way that I was gonna have to buy houses.
Same.
It's just like I'm gonna have to put it under my
Put it on
Fannie
your
and
personal
Freddie.
name,
Like
put
my wife
down
is gonna buy 10, and
20%.
I'm gonna buy 10, and then that's just
Yeah.
and then
20% down. It's,
Yeah.
No, so like in Daryl's example, I mean, 220 is what it appraised at, and he's gonna get a loan for 165. I mean,
Yeah.
you're looking at a 55,000. Is that 55? Yeah, that's 60. Yeah, that's 55. That's $55,000 of like equity
Equity,
that he
yeah.
has
Yeah.
sitting there, right? So like, instead of putting down 55,000 of 220, I mean,
Yeah.
that's a little bit more than 20%. That's like 23, 24%, right? So like, instead of having to come out of pocket $50,000, like he's just put in the sweat equity to make sure that
Right,
it appraises at
fixed
that
it
point.
up.
Yeah, he fixed it up.
When I first started, I thought I had to come up with that money.
Oh yeah.
Like you didn't even realize these
Imagine.
things existed.
Imagine.
I was like, how am I going to get a rental property at this point? I'm just going to flip houses. That's all I'm going to do.
Yeah.
The Burr changed the world.
The Burr,
The Burr changed the
But a
world.
lot
I
of
mean, it did in
people
the
are-
Ice Ages.
Yeah.
A lot of questions, though. Is the Burr still alive? I would still debate that it is, but it's getting harder.
Yeah, I would say that it definitely is.
It's always gonna be alive, but
Yeah.
just whether you cash flow or not with it.
You have to turn over so many more rocks. You have to talk to so many more deals.
Yeah.
You are going to leave some money in some, but there are going to be lucrative ones where you... Now, this is something that's super important to know is like, you got to get just base hits. Like, you're not going to hit home runs. Every once in a while, you'll get a home run, and these are the stories that you hear. But, like, as long as you're getting base hits, and you pointed this out a while back, as long as you're leaving less than 20% in the deal, like, you don't want to leave any money in, obviously.
Yeah.
But, like, if you leave less than 20, 15% in the deal, like, you're still doing better than, like, if you would have bought it
normally
the conventional way.
Down.
Yeah. So
when I'm looking at them, that's what I look at is if I can't get all my money back, I'm looking at, am I leaving less than 20%?
Yeah.
So where do people find these lenders?
Oh, they're everywhere. There's a lot more than you think.
Yeah, but where for someone listening? Where would they go?
I mean,
is there any specific lenders you want to shout out, or just type in DSCR lender on Google? Probably the best.
I would say message us.
Yes, message us.
And we'll give you some. We'll point you in the right direction. There are a lot of DSCR lenders out there. And
do you
some
typically use the same one?
I use the same one. I have been recently. I've been using the same.
Because I've used quite a few different ones. Now I've stuck with a couple of them that I like, but I've tested my waters around. I've tested the water around.
I did for a little bit, and you get burned sometimes.
So I agree.
Burned with points and stuff. You're talking about closing costs.
Points, closing costs.
I've had to come to the table.
Terms change.
Or not only that, they just take a lot longer. Like I've had a couple of them that are 60 days, and we still hadn't closed.
It's so DSCR lenders are like car salesmen.
Yes.
Right, where they they'll bring you in, they'll allure you, right? They'll allure you, they'll bring you in, and then they'll start wasting your time. And the next thing you know, it's like, bro, I've been with you for like 30 days, 45 days. Like, are we closing? And then they'll be like,
your terms change.
Shells moving around. It's like half a point higher.
Yeah.
And you're like, oh,
and at that point, you can't really back it. Or you can if you really wanted to, but then you're another 40-day process to do.
And if you're paying a hard money lender's interest, what's worth it? Paying a couple extra $1,000 here, or paying a couple extra $1,000 here?
Yeah.
They just lose their business with you in the future. Which
Correct.
Is a bad move on them.
Yes.
Yeah. So I would just say that give us a shout, send us a message.
Yeah.
We have some that we've all used, and I mean, we're doing it with some frequency. So like, if we're seeing and noticing that things change, we're also going to move to the next DSCR lender. But I'll be honest, like personally, the way that I've found my DSCR lenders is just through conversations with other people that do the same thing.
Now, question for you here. Your DSCR lender, what is their seasoning period? Because that's a big thing y'all need to ask. What your seasoning period is for these loans, because they're all different.
So it didn't have a seasoning period until like 30 days ago.
Oh, really?
It
changed?
You could refinance immediately. And I did.
Really?
Some I refinanced. I started the process like almost a day after I closed because I knew it was like a really short and then I would refi in 45 days.
Wow.
And now they've changed it to 90 days.
90 days.
Yeah.
Okay.
So that I feel like it's becoming normal.
I didn't know that.
Yeah.
So I've had a few of them change from 90 to 6 months, which is a huge difference. Yeah. I mean, it's horrible.
Yeah, I actually got that I got that notification on the refinance that I most recently did.
Yep.
They said 90 days leading up to like 3-4 days before, and they were like, "Oh, because you're getting so much money back, you have to wait 6 months." And I was like, "Nah, that's not." Yeah. So my heart sank, and I was like, "I'm just gonna have to leave $25,000 in the deal
into this."
Yeah.
Oh, you didn't want to wait 6 months, or switch lenders to someone that did require 3 months?
No. I would have probably preferred to just like wait another 3 months, but then the waiting another 3 months, they don't lock rates, right? So then you're again playing the waiting game and hoping things don't change, and they might toy you around, and you might wait the 6 months, and then at the very end, it might be like, "Oh, you're at like 8.5%," and that would have been really frustrating. But at the end, I don't know, it worked out. Some strings were pulled.
What What about yours, Dylan? Tip 90 days or 6 months?
Well, I was using the same one as Carlos. I didn't know they changed to 90 days actually. So
okay.
that's new for me.
Nice.
But yeah, usually it was right away. I could call them.
See, mine has always been 90 days. The guys that I use, I've never used y'all's guy, but
That's not that big a problem. I mean,
Oh, no, so
45.
I'm
You
good
could
with
start
90
at 45 days. in.
the reason I like 90 days is, for one, it gives me 30 or 45 days to finish the house, fix the house up. Then I get a couple of months rent before I even get to the refi, and then now you're getting 2 or 3 months of straight rent, not having to pay any mortgage or expenses.
You're paying interest though.
I mean,
regardless.
you're paying interest, yeah. But a lot of times, like with my hard money lender, he does at least a 2-month minimum. So
he does.
Yeah, he does at least a 2-month minimum. So I mean, what's the difference?
Yeah.
So
I don't know. There's a lot of options out there. I would say definitely just ask trusted people that you use.
Yeah.
Because another thing that we didn't really talk about is like appraisals mess you up. So like you get a DSCR loan, the interest looks good, everything looks good, and then they send somebody out as a third party appraiser or whatever, and then that person's just not
lowballs you.
Yeah, they just don't see it the way you see it or the way that the market sees it, and it just decimates you. And it's not just the appraisal, but it'll be the appraisal and then rent, and then that'll like crush your ratio.
Yep.
Mm-hmm. And then
the only thing you can do is contest it and then pay for another appraiser to come out.
Sometimes they don't even let you do that though.
Oh, I know.
They usually don't let you unless you switch a whole new bank. They don't let you just get a new appraiser.
And it sucks. Which really sucks is a lot of times these appraisers are coming from out of the area.
Yeah, that's
which is the worst. Like I had one come from 60 miles away. You're gonna tell me what this market's like if you're living 60 miles away?
Yeah.
I mean that's an hour, and he lived an hour and 30 minutes away.
Gosh.
Yeah. And came to appraise the house. Luckily, I got a decent appraisal. It wasn't what it should have been, but it was decent.
It could help if your house is in a bad pocket,
so
and then the houses around it are in
correct.
good pockets.
But this house was in a great area that was next to the bad, and he pulled comps from the bad side. It was in Colonial Heights. He pulled comps from Petersburg and not Colonial Heights, which hurt my appraisal.
Yeah.
But granted, it was still good enough to where I could refi, but it wasn't what it should have been.
Yeah.
All right. Well,
DSCR loans.
Ask around. Local banks also might know people, or they might do it themselves. So if you need someone, call a local bank, or just reach out to us.
Some of the local banks do like shorter loans, though.
Yeah, they do ARMs.
They do ARMs.
So it's adjustable rate mortgages, meaning the rate adjusts every 5 years.
3,
but
5,
it's still the
7,
same thing. They go up the same criteria.
But their amortization schedule
is shorter. Makes it
15,
harder.
20. Yeah, it'd be harder because the calculations on like a much larger monthly mortgage.
Yeah.
But you do pay off the loan a lot faster, significantly faster.
Yeah.
And we didn't even go over that. These DSCR loans that we're getting are 30-year fixed mortgages.
Yeah, we should have said that at the beginning.
Because that's huge. A lot of people think they're 10, 15, 20. These are 30-year fixed rate.
Yeah.
So don't think that they don't exist, because they do.
Yeah. No credit.
And
no job.
No credit.
No, they run credit.
They
Sorry.
Credit.
No job.
Correct.
No tax returns.
Nope.
And 30-year fixed.
30-year fixed.
Just lease in place.
Yeah. Now they usually do have prepayment penalties, so throw that in there.
Yeah.
I know at least mine have a.
Do you know what
3
a
to
5
5
is? No?
Yeah.
What's a prepayment penalty?
If you pay the loan off early, they'll charge you some points, meaning they'll charge you 1% of loan. If you're paying off $100,000 loan early and they charge 1 extra percent, you have to pay $1,000 when you pay off that loan. An extra $1,000.
And some of the prepayments are in descending order.
Mm-hmm.
So if you refinance or sell the house within the first year, they'll charge you 5 points.
Yeah. Correct.
$100,000 house, 5,000 just off the break.
Yep.
4,000, 3,000, and
as the years goes on, that prepayment penalty lessens until after 5 years it's 0. Then you can refinance.
And some of them are less than 5. Like the one I just did was a 3-year.
Yeah. It all depends on the lender.
And it started at 3%, 2%, 1%, 0.
Yeah.
So.
All right. Well, that's it for DSCRs. There's a lot more. So if you guys have more follow-up questions or you guys want to learn more about DSCR loans, let us know. We can definitely give you a live, real example, or we can answer more detailed questions. But yeah, that's it.
Subscribe, hit the like button.
Comment.
Yes, comment.
Yes.
Yes, tell us what you think. Feedback.
Share.
Ask some questions.
Yes.
All right, guys. Carlos, Daryl, Dylan, Generation.
Oosh.